Welcome to another episode of A Quest for Twice. Today is the last day of October. So last week, the three tech giants had a terrible week. So we can see that on this plot, the black line is the percentage performance for S&P 500 in last week. So it ended the week up by about 3%. Comparing to the Google, that's down by about 4% for the week. And Amazon was down by about 12-13%, and was down at the moment for over 20%. And the Meta platforms, aka Facebook, was down by about 21%. So obviously they reported their Q3 earnings last week, and the investors didn't like those earnings. So today I'm going to dig into the earning updates from Amazon.com and Meta platforms, because I already reviewed Google's financial report last week. I do want to highlight some numbers here before I go into the earning updates. That is the number of employees added by the three companies in the Q3. So Google added about 13,000 employees in the last quarter alone, and Meta Platforms added 3,800 employees, and Amazon.com added 21,000 employees. So did their stock price performance had anything to do with the number of employees added? Let's take a look. So Amazon reported a pretty decent sales growth, 15% year-on-year, versus 7% growth in the Q1 and Q2 of this year. The sales growth were actually stronger at 19% if we remove the currency impact. However, that sales growth was influenced by the timing of Prime Day, which was in Q3 this year versus Q2 last year, and that added 400 basis points to the sales growth. But importantly, Amazon gave a disappointing growth outlook for the last quarter of this year, about 2 to 8%. That's pretty weak, and that's obviously disappointing to investors. And also, what's worrying to investors is the decelerating AWS. Came in at a 27% sales growth in last quarter, compared to 37% and 33% in Q1 and Q2. So if we look closely in this plot, that's Amazon's segment growth year-on-year plotted for each quarter. So you can see that the advertisement grew the fastest, almost 35%. So that was an acceleration. As I mentioned, the AWS decelerated, came in at 27%. Its third-party sales growth was strong, around 20%. Obviously, that was helped by the Prime Day timing. And the same case with the other three segments: subscription, online sales, and physical store sales. That's around the high single digit. Perhaps it's a little concerning is the subscription growth. That's reasonably weak, and there is no uptick, considering that Amazon has raised its Amazon Prime's subscription cost, and also it has been rolling out some very high influencing Prime video programs, including Thursday Night Football, as well as Lord of the Rings spin-off. So the subscription growth is actually disappointing. However, I think the more alarming to investors is the profit margin of Amazon. Its operations margin was 2% in Q3 versus 4.4% 1 year ago. And that's a reduction from 3% achieved in the first half of this year. So we need to dig in to see what caused the margin degradation. So you can see in the plot on the top right, the cost of goods as a percentage of revenue, as well as fulfillment cost as a percentage of revenue. So the cost of goods has actually declined compared to 1 year ago. It's below 56% of revenue. Its fulfillment cost also declined from first 2 quarters of this year as well as 1 year ago. So Amazon has been doing a good job of controlling the direct cost in terms of cost of goods and fulfillment. So what's the culprit of the margin degradation? So Amazon had higher technology and marketing cost in the last quarter, up 35% from 1 year ago. And that's consistent with the number of employees added in last quarter. Because of the cost increase in those areas, it caused the margin degradation. Additionally, AWS operation margin declined to 26% versus a norm of 30%. And that's due to the energy inflation and the looming recession causing the softness in its price. That's shown in the figure on the bottom right. You can see the orange line is the year-on-year AWS growth. That significantly picked up since the onset of the pandemic, from a norm around 30% up to the peak at 40% at the end of last year. Then it has been declining to below 30% of year-on-year growth in the most recent quarter. And also, the AWS ops margin in the past has been hovering around 30%, as shown in the gray line, and but its margin declined significantly in the most recent quarter at 26%. So you can also compare with the Google Cloud. So I plotted the recent Google Cloud year-on-year revenue growth figure, and it also had a peak around 45% from 1 year ago to the beginning of the year, then decelerated to about 37% in the most recent quarter. But at least its Q3 growth was higher than the Q2 growth. Compared to Amazon, its Q3 growth was significantly lower than the Q2 growth. So that's very disappointing to investors. However, we can see its stock price actually reflected all that disappointment. Currently, its enterprise value over gross income is only 5.5. That's the lowest in the trailing 10 years. Now let's take a look at the Meta platforms. So at the bottom right, it shows its stock price. It had a spectacular fall in this year. So it reached a peak over $375 about 1 year ago. Then from there, it had a dramatic fall, and had a stock price went under $100 in last week. That's remarkable because the last time its stock price was below $100 was in 2016. So that's more than 5 years ago. its current stock price is even lower than the bottom reached in March 2020 when there was a great deal of panic from COVID-19 pandemic. So what's going on? So for Meta platforms, the bad news were actually quite a lot. The first one is its revenue growth or lack of. Its Q3 revenue was down 4% compared to 1 year ago. It will be up 2% if the foreign exchange headwind is neglected. So that compares to 7% growth in Q1 and flat revenue growth in Q2. To make things worse, its Q4 revenue guidance is down 7% compared to 1 year ago. So for the whole year, its revenue growth will be negative most likely. Of course, part of that is caused by the very strong US dollar. But the main problem is lack of growth. So it's at the mercy of the currency exchange. Another significant bad news is its ops margin declined to 20% in the most recent quarter compared to 36% 1 year ago. But if we look closely, we can see that it's driven by a 19% year-on-year increase in R&D expense. Again, that's consistent with the number of employees added in the most recent quarter because most of them went to R&D department. Related to expenses, Meta Platforms gave a gloomy outlook for 2023 with the expected expense up 15% per guidance. So if next year's revenue is flat, then its operation margin will be hammered again. And its operation loss from investment in Metaverse also increased to a loss of $3.7 billion in last quarter alone. Investors consider all this as bad news and severely punished Meta Platforms' stock price. So if we look at its core Facebook business, its user growth is actually pretty slow and steady in the last quarter. There was no fundamental issue with its user growth. Facebook disclosed that its number of impressions were up 17%, but achieved lower advertisement price at negative 18% from 1 year ago. That's partially driven by lower advertisement monetization from videos, especially short videos. So if we look at the revenue per user, then in the Q3 of this year, it was $49 per user in the US and Canada, compared to more than $52 per user 1 year ago. So that's a decline both year-on-year as well as sequentially from Q2 of this year. The degree of decline is actually less severe compared to its revenue per user in Europe. That was $14 per user in Europe in the most recent quarter compared to $16.50 1 year ago, and $15.64 from Q2 of this year. So that drop was a lot more severe compared to the US. For Asia Pacific, its revenue per user is a slight increase from 1 year ago and a slight decline from Q2, and a very similar picture for users in the rest of the world. So slow growth in the number of users as well as less monetization from each user caused its revenue to have a slight decline. So obviously, Meta Platforms' business is not doing great. However, we also need to look at the valuations. So if we look at the enterprise value over gross income, it comes in at 3, at $100 per share. That's significantly lower than that metric since it went public. And the EV over EBIT is less than 9, and implies a further contraction of EBIT. And if we focus on cash flow, the yield is over 15% despite the heavy investment in R&D and the metaverse. It actually generated over $50 billion in the trailing 12 months, comparing to $58 billion in last year and $39 billion in the year of 2020 during the pandemic. So the CFFO is significantly higher than CapEx plus mergers and acquisitions, which were $20 or $22 billion in 2021 and 2020, as well as an outlook of $33 billion as well as $37 billion in this year and next year. As a result, Meta Platforms has spent $21 billion for share buybacks in this year so far. And that's 8% of current market cap. So market is extremely negative about the growth of Meta Platforms. It forecasts negative growth and is ignoring the opportunities in the Facebook revenue growth outside US and Canada, and the monetization of WhatsApp, and the potential in metaverse. So to summarize my thoughts on Meta Platforms, I think it may not be classified as a growth company anymore, but it is very attractively priced. It has a wide moat from strong network effects. So its future revenue should be well protected. And the opportunities are a stronger monetization of short videos. According to Facebook management, it actually generated a $3 billion run rate based on the recent quarterly report. Of course, we have seen that in this year, the online advertisement is not immune to recession. So with the recession looming, its revenue in this year and next year may take a beating. However, Facebook is making progress with the monetization of WhatsApp, including its rollout of click-to-messaging ads and business messaging. I would say right now the investors are focusing on the threats, especially the wasted investment in metaverse is a loss of $9.4 billion in this year alone versus $6.9 billion of operation loss in the same period of last year. To put everything together, do I think the punishment in the stock price of Google, AMZN.com, and Meta Platforms justified? As I pointed out earlier, they share something in common, that is significant numbers of new hires in the most recent quarter. The new hires really went into R&D and drove a significant rise of R&D expense in the recent quarter. And the operating income for all three companies had a significant decline, mostly because of the increase in R&D expenditures. So my thoughts are, R&D expenditure is really an investment in the future. For Meta Platforms, of course, it's investing heavily in metaverse. So there is a real risk that it could be a bad investment, a waste of shareholders' value. However, for AMZN.com and Google, there is no reason to doubt that their investment in R&D in the recent quarters will not be as productive as the R&D expenditures in the previous years. They have a very strong track record of doing strong investment in R&D and generating long-term revenue growth and shareholder returns. So in my opinion, the investors are focusing too much on the short-term profitability and treating investment in R&D as an expense and punishing their stock price unfairly. And this creates an investment opportunity for me. Of course, this short-term thinking is very prevalent in the current high interest rate environment. So that may persist for a few months longer. So I need to think about my timing to buy those company stocks. But I have no doubt that they present good opportunities for a long-term investor like myself. Lastly, a quick update on INMD. It reported very strong financial results from the most recent quarter, with a revenue about $121 million, maintained a high gross margin around 84%. As importantly, the management raised its full-year revenue guidance to $450 million. That's a raise over previous raise released after Q2 results came out. So it has a very strong momentum in its business. But to me, more importantly, it also proved the credibility of its management, because we can see that for Q1, its revenue was $85.9 million. Management knew that was a disappointment to investors, and gave the reason for the revenue decline was impacted by the pandemic in Asia and the upgrade cycle of new hands-free equipment. So the recent results prove that they were right. They were truthful of the explanation of the Q1 revenue disappointment. To me, the credibility of management is very important. So that's a very good sign of a good company in mode. And look at its valuation level. Its forward PE is 13.5 at the current stock price. And its stock price had a significant decline in the trailing 12 months, from a peak almost $100 to the current price level around $35. But if we look at the trailing 12 months, that's shown at the bottom left, the orange bars, it has been keeping on going up. So there is really no issue with its business despite the huge drop in its stock price. So as a result, its valuation level now is very attractive. Price over sales, as plotted at the bottom right, has declined to about 7, comparing to about 9 before the pandemic, with a peak over 20. So I would say the over-optimism during the boom following the pandemic has faded. Now the market may be just mispricing a very strong growth company with a very strong cash flow. So I also believe INMD presents a very good investment opportunity. This concludes the latest episode of Quest for Twice. Until next time, happy investing.